Think about the last time you bought a loaf of bread or a cotton t-shirt. The price you paid at the register likely hasn't changed much over the last few months. It feels stable. But zoom out from that retail price, and the raw materials needed to make those products are in a state of constant chaotic flux. Wheat and cotton face unpredictable droughts, suffer sudden freezes, and global supply chain shocks that send their value wildly swinging from week to week. Humans have always tried to wrangle this chaos. In ancient economies, trade was handled through direct barter. You swapped a bag of grain for a cow. It worked, but it was inefficient because there was no standardized measure of value. The introduction of money upgraded this system into the spot market. If you grew a crop, you loaded it up onto massive riverboats or wagons and brought it to a central physical location to exchange it immediately for cash on the spot. For a farmer, this was a terrifying way to make a living. You could spend an entire year laboring over a crop, only to arrive at the market on a week when a massive oversupply suddenly crashed local prices, leaving you in financial ruin. To survive that volatility, merchants and farmers came up with the forward contract. If we look at this timeline, you can see how it works. During the spring planting season, a farmer and a merchant agree on a locked, fixed price for the crop that won't be delivered until the autumn harvest. But watch what happens to this chart if the autumn harvest is surprisingly huge. The market spot price plummets. The merchant is now locked into a contract to pay way more than the crop is currently worth. Their financial incentive is to simply walk away and let the farmer take the loss. The reverse was true for the farmer. If a terrible drought ruined crops everywhere, the spot price spikes up. The farmer is now incentivized to break their spring contract and sell their scarce harvest to the highest bidder. These agreements were routinely ignored. When either side stood to lose money, they defaulted. It created an environment of zero trust. As the industrial age took off, cities were expanding rapidly. Global supply chains could not scale to feed and fuel this new world until a system was invented that made it structurally impossible to break a financial promise. The solution was to pull everyone into centralized hubs. We saw this begin with the Osaka Rice Exchange in the 1700s, and later the Chicago Board of Trade in 1848. These exchanges stepped directly into the middle of every trade. They created the futures contract, a legally binding mechanism where the exchange itself guarantees payment to the winner, even if the losing counterparty defaults. To make that guarantee work, the exchange stripped out all the variables. They standardized every single contract, dictating the exact quantity, quality, and delivery dates of the commodity to remove any room for interpretation. This created a highly efficient tool for our first main player, the hedger. These are actual producers and consumers of physical goods, like airlines buying fuel or bakeries buying flour, who use these contracts specifically to eliminate their exposure to price risk. But risk doesn't magically evaporate. If a hedger wants to shed the danger of unpredictable prices, there has to be an opposing party on the other side of the trade willing to take that risk on. That opposing party is the speculator. They are investors who willingly absorb the hedger's risk in exchange for the opportunity to profit if they predict the market's price movements correctly. Speculators operate entirely in the realm of financial paper. When they buy a contract for 10,000 barrels of crude oil, they have absolutely no intention of ever taking physical delivery of it. They will liquidate their position before the contract expires. Yet, for all this invisible financial trading to mean anything, it has to be tethered to reality. The derivatives market is completely dependent on a massive, complex logistical ecosystem that handles the actual physical goods. This physical infrastructure operates on an immense industrial scale. We're talking about vast accredited warehouses, independent assayers who test the quality of raw metals, and global transport companies moving millions of tons of material. A functional commodity market is actually two parallel systems running in sync: a physical supply chain moving the actual goods, and a financial exchange moving the invisible risk. Today, the scope of these markets covers nearly everything the planet produces, divided broadly into soft, perishable agricultural products and hard, mined natural resources. They have evolved into highly sophisticated instruments. Institutional investors, hedge funds, and sovereign wealth funds now use commodity derivatives to balance global portfolios. At a macroeconomic level, this system provides two vital services. The first is risk transfer. It acts as a global insurance policy, preventing producers from going bankrupt every time a sudden geopolitical crisis or weather event shocks the supply chain. This diagram illustrates the second core function, price discovery. The market acts as a giant predictive engine, continuously sucking in global data on weather patterns, trade routes, and supply metrics to accurately estimate what raw materials will cost in the future. The everyday prices we pay at the register are not random numbers. They are the engineered result of a centuries-old tug-of-war between risk and reward that quietly keeps the modern world fed, fueled, and functioning.